Alex Coffey's with us, co-host of Next Gen Investing, looking at these numbers. So what do you got on your mind here this morning on this Wednesday as we see some green arrows as we kick it off?
Yeah, good morning, Nicole. Happy Wednesday. Taking a look at S&P is obviously a really nice open, gap up opening. Yesterday, the day was all about 62.25. Bulls are hoping that some of these levels from the last 2 days maybe aren't relevant, but maybe early this trade could be centered around 62.50, which is where we essentially are trading right now, just above that. If we look at the intraday chart that I sent over to the team, I always kind of do this sort of traffic light or stoplight setup, red, yellow, green, just because of the visuals. Resistance in red, we spent yesterday mostly around sort of that neutral balance point in the middle, again, 62.25. You saw how relevant that was in a pretty quiet day. Today, already beginning the day up on the upwards bounds of resistance. So 62.50 may be an early battleground for this market. If we are to get through there, you got to zoom out a little bit further in time, but perhaps, not really a huge stretch to start thinking, basically getting to where we gapped down, just a couple days ago to 62.60. And then beyond that, I mean, you're looking back towards those highs up near 6,300. So certainly an interesting start to the day. We'll see if anything can get in the way of what's a really nice start here on this Wednesday.
Okay, thank you for that chart. And we see that gap up. How about the S&P 500 overall? What do folks need to focus on here?
Yeah, one of the things that we've talked about across the coverage the last few days is, there's been a couple maybe red days back to back, but in the grand scheme, it doesn't really set back anything, especially on a technical front. If you were to look at the last 3 months, it's been a really, really solid uptrend off the lows. Obviously, exactly 3 months ago, one of the strongest market performing days in the history of the market. But even that aside, it's been steady. And these levels have held. The two lines that are accompanying the candles of the day-to-day trade are a 1 week moving average and a 1 month moving average. Those who have watched my commentary here on the network over the last couple months, I've talked about how just this one indicator would have avoided so much of the drawdown when that 1 week crossed below the 1 month way back at the end of February. If you use that as a signal to get out, you wouldn't have had to got back in if just solely that indicator until the end of April. So yeah, you would have missed maybe the early parts of the turnaround, but you would have missed the vast majority of that drawdown. And then, of course, you've participated pretty stress-free since then as this market has continued to work its way back towards highs. Those are also levels that can act as support points on down moves, and it's been that way all week long. That 1 week moving average has been support the last several trading days. And then finally on the bottom, two momentum indicators basically saying, hey, things are still pretty strong on a momentum front.
Okay. And when we look at the VIX, why is that important now to take a look at?
Yeah, one of the big things that I think many are highlighting right now with volatility is how low it is and how it's been, grinding lower. And if you look at the VIX, I would agree with that. At 16, we're far closer to normalized average levels over time, despite all the uncertainties we talk about. But if you look at the VIX curve, which is what we have here on the screen, this is VIX futures basically over time. So as you move left to right on this chart, Nicole, we're going from, rather than looking at, the same VIX chart over time, we're looking at, hey, where are August futures, then September futures, then October futures, all right now. And what you're seeing is the market might be complacent about what happens today or even over the next month. But as we increase time, there is a realization and an acknowledgement within the market that these risks are real and they do exist. And there's a premium for time right now when it comes to volatility. Right now, the July futures are at 1730. But if you were to go out to the end of the year, you're closer to 22 when you look at the VIX for December in terms of futures. And so when I look at that, what I see is a market that is not running away from the risks, acknowledges that they're real, but doesn't see them taking place today. And I think that's the key point to take away. Maybe complacent for the next couple of weeks, but not complacent overall.
Okay, and look, I mean, as you talk about that, NVIDIA hit a record high today, 163.57. We were talking about the market cap and looking at that. But just the fact that NVIDIA, when you talk about the VIX and the volatility, we're up 70% from the lows. That's incredible, right? Everybody who was a believer and got the chance to really pick it up, and now it's at 163 and change. Thank you so much, Alex Coffey. Great to see you. Appreciate it.